Hello, I'm Sarah from Filing Taxes, your trusted tax partner. Today I'll discuss the significant tax implications of divorce and separation in Canada. Going through divorce or separation can be emotionally challenging and may bring unwanted financial strain. However, there are opportunities for tax savings that can ease the financial burden during this transition. Let's talk about them in 6 simple steps. Number 1. Division of family assets. When going through a divorce or separation, it is important to consider the after-tax cost of dividing your family assets. Let's say both you and your spouse own a family home with a fair market value of $600,000. Your spouse has $600,000 in RRSPs and $200,000 in non-registered investments. Your share of these assets is half or $400,000. Now comes the crucial decision of which assets to keep. The goal is to maximize the after-tax value of your share if you choose to keep the RRSPs and non-registered investments. Your after-tax value would be $240,000. This is because cashing in the RRSPs would incur a tax rate of 40% based on the gross amount of $600,000. Additionally, selling the non-registered investments would result in a capital gains tax rate of 20%, leaving you with only $40,000 after tax. On the other hand, if you decide to keep the family home, your tax value would be $600,000. This is because you can claim the principal residence exemption, making the entire amount tax-free upon sale. In summary, it is essential to carefully consider the after-tax implications when dividing your family assets during a separation or divorce. By weighing the tax consequences and maximizing your share's value, you can make informed decisions that align with your financial goals. Number 2. Avoiding cashing in RRSPs. It is advised to avoid withdrawing funds from your RRSP when dividing marital assets. There exists a specific provision in the Income Tax Act that permits one spouse to transfer their RRSPs to the other spouse during separation or divorce. This provision proves beneficial when making an equalization payment to your spouse. Failing to take advantage of this tax rule will result in the need to cash in your RRSPs, which are subject to full taxation, in order to make the equalization payment. Let's consider the case of John and Emma, who are currently undergoing divorce proceedings. The total value of their shared assets amounts to $18,50,000 or $9,25,000 for each of them. John desires to retain the ownership of the family home and artwork, while Emma wishes to keep the RRSPs. They both agree on this division of assets, but it results in John receiving $450,000 less than Emma due to the significant value of the RRSPs. To ensure fairness between them, Emma makes an equalization payment of $225,000 by transferring it to John's RRSP account. As a result of this transfer, both John and Emma end up with $9,25,000 worth of assets each. Number 3. Update CRA. It is essential to keep your information updated by notifying the Canada Revenue Agency about any changes in your marital status, especially if you have children. This becomes particularly important when you go through separation or divorce. The amount of Canada Child Benefit you receive for your children depends on your family income, which includes both you and your spouse's earnings. However, if you are separated or divorced, only your income will be taken into account for calculating the Canada Child Benefit you are entitled to. As a result, updating your marital status to either separated or divorced is likely to lead to an increase in the amount of Canada Child Benefit you receive. Number 4. Split property ownership. If spouses jointly own multiple properties, allocating one property to each allows both to claim the principal residence exemption separately. Number 5. Tax deductibility of legal fees. Legal fees paid to collect support payments are tax deductible, while fees for preparing separation agreements or asset disputes are not. Number 6. Eligible dependent tax credit. In cases of joint custody, decide which spouse will claim the eligible dependent tax credit, as only one can claim it. In conclusion, understanding these tax implications can help save money and alleviate financial stress during divorce or separation. For more tax tips, subscribe to our channel and visit our website. Follow us on social media for regular updates. Thank you for watching.